Hello, welcome back. So in today's video, I'll be talking about the markets hating all these different earnings. So for reference, this is my portfolio. So I own one of the stocks that I'll be covering today. And this company is none other than Visa. So I own around 3% of my entire portfolio in Visa. Of course, I would like to increase my position size, but currently I would say Visa is slightly overvalued. So the company reported their earnings. They were initially down around 3% and currently is up around 0.4%, trading at a 35 times earnings and giving you a 0.67% dividend yield. So for Visa, this is their earnings. So the net revenue came in 14% above last year's revenue. The GAAP net income came in at 8% above last year. The GAAP earnings per share increased by 12% and non-GAAP earnings per share went up by 23%. So overall for Visa, this is just a stable business that will keep giving you returns over time. And when it comes to owning your stock, you want to own stocks with strong fundamental growth so that you don't need to rely so much on multiple expansion for your stock to appreciate over time. And for Visa, this is the case. This is probably one of the best companies out there. And besides that, the US economy is also strong. So GDP in Q2 of 2025 came in at 3%, which is above the estimate. So the estimate was around 2.2%, and they came in at 3%. So this clearly shows that the US economy is still strong. And for Visa, you will likely see earnings going up as usual. So for Visa, this is my fair value for the stock, of course. So at $305 per share, I can get around 12% return from this company. And so $305 a share would be my prime entry for Visa. I think the company now is still slightly overstretched in terms of the valuation. So hopefully the company can come back down to this price and I'll start adding at $305 a share again. The next company that I'll be covering is Booking. So Booking is down around 2% today. It is currently trading at a 34 times earnings, giving you a 0.7% dividend yield. So for Booking, this was their earnings. So revenues went up by 16%, net income went up by 26%, and diluted EPS actually came in at 32%, the adjusted value. So for Booking, it is a strong company. I mean, revenues increasing by 16%. It's quite decent for any given company. And for Booking, this is the entire story of the company. It's basically just a strong business with earnings per share coming in from buybacks as well. So the company has bought back a significant amount of their shares over the past few years. In the past few years, it has been around 5 to 6% CAGR in terms of the share reduction. So if they can continue sustaining this, if they can continue sustaining the 5 to 6% buybacks, then if you are to add on their earnings growth, then this company could easily give you a 13 to 15% EPS growth. So for Booking under the agency and the merchant portion, their competitive advantage include network effects, scale, and pricing. No one is bigger than them in Europe, of course. And under the Airbnb side, where you have a host, Airbnb is currently still bigger than them. So Airbnb has your first mover advantage, whereas Booking focuses a lot more on cutting prices. So what Booking likes to do is to offer the lowest price possible, and that is sort of like the moat for the company. But for Booking, this company looks expensive today. It was undiscovered probably 1 to 2 years ago, and that's why the multiple was so low. But without a very strong moat, the company seems expensive today. I mean, the company clearly has a strong business, but to say that it has an impenetrable moat is a bit far-fetched. The company still relies on a lot of ad spend in order to drive traffic into its page, and the company's competitive advantage now is simply just to lower costs for its consumers. And if you're to compare the app interface between Airbnb and Booking as well, Airbnb clearly stands out as the winner in this case. So the uncertainty in your economy will cause people to cut out discretionary spending, and the travel industry will be hit first. So Booking is highly cyclical because when uncertainty comes, your consumers, the first thing that they'll be cutting is the one that they don't need the most, which is travel. So of course they'll be cutting travel first. And for Booking, if an economic downturn comes, then this industry will be the one that is first hit and hit the most as well. The next company that I'll be covering is one that isn't really covered, is this company called ODFL. So this stock is currently trading at a 27 times earnings, and it is giving out a 0.75% dividend yield. The stock today is down around 8 to 9% after reporting its earnings, and it is near its 52-week low. So for this company, it's basically a trucking company, and if you're to look at the fundamentals of the company itself, the fundamentals are really strong. Of course, they're cyclical because trucking is heavily tied to the economy as a whole, similar to your travel. But overall, if you're to zoom out and look at the fundamentals, this is the earnings of this company. It is extremely strong. It clearly shows that the company has something working for them, and that's why the earnings per share has been growing so steadily over the past few years, although it's a bit cyclical. So this company currently holds around an 11% market share in your entire trucking space. Your entire trucking space in the US is heavily fragmented by many different small companies. And for this company, it is sort of like the most dominant one out there amongst the 100% market share in your trucking industry. So for this company, if you have to look into the metrics as well, the metrics are incredible. So the one that we always focus on is your ROIC, your return on capital, as well as your return on capital employed. So return on capital employed is 28%, return on invested capital is 20%, return on equity is 26%, return on assets is 16% as well. So when you have metrics like this, it clearly shows that the company has a strong underlying business in order to achieve great amounts of returns on the invested capital. So for this company, it could be one that looks interesting today. So the trucking industry is cyclical as a whole. With economic expansion, you will see more goods being shipped, which leads to more trucking being needed, of course. And the converse is true as well. So when you see some form of economic contraction, then your trucking activities, they will start to fall. The trucking industry is facing normalization after the post-COVID boom, and currently now it is dealing with the trade war as well. So for this company, if the economy stabilizes over the next few quarters, then you will likely see earnings recovering again. And for this company, it is probably the highest quality company in the entire trucking space. The next stock that I'll be covering today is Brown & Brown. So Brown & Brown over the past 5 days is down around 10%. It reported its earnings around 2 days ago, and this company is currently trading at a 26 times earnings. So for this company, the fundamentals are solid. I mean, it is similar to the other company that I talked about earlier, which is ODFL. So for Brown & Brown, if you're aware of how the insurance brokerages work, then this company could be an interesting one for you to look at. So for Brown & Brown, it is an insurance broker company, basically without a very strong moat, but the fundamentals clearly show that the company is some sort of quality. If you're a pro in the space, then this stock looks interesting right now. But of course, I wouldn't be investing into this one. I think the insurance industry as a whole is an extremely complex business. So for Brown & Brown, it is an avoid for me. Next, I'll be covering Tesla and Samsung deal. So Elon Musk actually said a few days ago that Tesla and Samsung have signed a $16.5 billion chip deal. So he basically said that Samsung agreed to allow Tesla to assist in maximizing manufacturing efficiency. This is a critical point as I will walk the line personally to accelerate the pace of progress, and the fab is conveniently located not far from my home. The 16.5 billion number is just the bare minimum. Actual output is likely to be a lot higher than that, and this is what he said in his post. So this piece of news is actually bullish for one of the companies that I own, and if you haven't guessed it yet, it is none other than ASML, of course. So ASML today is currently trading at a 24 times earnings, up around 2% year to date. And for ASML, this deal itself is beneficial for the company as well, because Samsung has previously said that they'll be cutting the capex in terms of the machines that they basically buy in because of the lack of sales. And with this Tesla deal coming in, you could easily see them start placing orders for all the different lithography machines, which will be beneficial for ASML as well. So for this company ASML, it is currently trading at a discount relative to its semiconductor peers, although it is probably the highest quality in the entire space. So for ASML, I view it as a decent buy at today's price. I think the company currently has very bad sentiment, which is often a good time for you to enter into a company like this. Last portion, I'll be covering some questions left in the comments. So the first one, it says, what is your opinion on Alibaba, Fiserv, as well as Novo Nordisk? So I covered Novo Nordisk yesterday, and I'll be covering the first two today. So Alibaba is a stock that is up around 39% year to date. It is currently trading at a 15 times earnings. So for Alibaba, I view it as a decent company, not high quality of course, because in China, a lot of your different e-commerce companies, what they like to do is to basically drive down prices. And when that happens, you will often see a price war, which will eat into the margins of every single e-commerce company. So for example, JD, Pinduoduo, as well as Alibaba, they've been aggressively lowering their prices, which has hurt the e-commerce portion of the business in terms of the margins. And this is typically not what you like to see when it comes to owning your companies. You don't want them lowering their margins over time because it is not sustainable, of course. So that is one portion of my concern with Alibaba. The next concern is simply just the capex that they're spending in the company. So they're placing a lot of money into your AI data centers, The company hasn't shown very good capital allocation over the past few years. I mean, the only time that they did well was when they bought back a lot of shares. But beyond that, when it comes to investing in a business, the company has not been very successful in doing that. And that is the concern that I have with the company. I'm afraid that they may be pumping a lot of money into investments in AI, which will not yield them returns over time as well. So that is the other part of the concern. But of course, Alibaba at today's valuation seems a compelling buy. It is currently trading at a 15 times earnings, and if you are to normalize it, it is probably trading at around a 17 times earnings, which is still quite decent for a company that holds a dominant market share in your Chinese e-commerce platform. The next stock that I'll be covering is Fiserv. So Fiserv is down around 31% year to date. It is currently trading at a 23 times earnings. So Fiserv actually dropped because of their earnings itself. They reported lower growth in terms of their Clover platform, their POS. That portion was actually acquired by Fiserv, and they took on a lot of debt for that portion, and currently now is seeing slowing growth. So that is one portion that is negative as well. For Fiserv, if you were to look at the fundamentals of the company seems like a compounder. But for me, I think the company's business model is a bit too complex, and so I'll be avoiding this one. It's in the too hard pile. The next question that I'll be covering is with regards to Moody's. So this question actually said, what is your fair value for Moody's? So let's take a look at Moody's stock. Moody's stock is up around 9% year to date. It is currently trading at a 43 times earnings. So for Moody's, they just reported their earnings. They have forecasted that they will be growing their EPS at around 10 to 12% this year. So for a company that is trading at 40 times earnings, growing EPS at around 10%, that is a 4-pack. So I think for now, Moody's is quite overvalued. And my fair value between $400 and $440 a share. That was when I initially bought into the company. I'll be waiting for a better entry to add on to my Moody's position. I hope you guys have found this one useful and invest safe.